All right, so as any trader would know that has used or developed a trading strategy, trading is all about recognizing patterns, right? The goal of a trading strategy or methodology is to identify a recurring pattern in the market and place trades when a repeat occurrence of that pattern is expected. This is the basis of trading, right? Here's a very insightful quote for traders and very applicable to what we'll be talking about today. History is never antiquated because humanity is always fundamentally the same. So humans respond to the same environment in the same way, which means that if a particular environment repeats, the human behavior associated with that environment will also repeat. And in the case of the financial markets, since they're a function of human behavior, even with the advent of algorithmic trading, when the same or similar environment occurs, whether it's technical metrics or the geopolitical climate, whatever that is, the traders respond in the same way. So like Solomon says in Ecclesiastes, there's nothing new under the sun, right? History is full of recurring themes because humans keep doing what humans do, which means there's always patterns to be found in the market. And that's incredibly useful to traders. This allows us to make a very important conclusion. The past is a map of the future. And this is exactly what traders should be focused on, studying past data for patterns that then present opportunity when they reoccur. So keeping in this vein, to warm us up here and provide some context for what I'll be unveiling later, I'm going to introduce you to a technique for recognizing a very predictive price pattern. I studied this technique under Daniel Rowe, and I've spent literally hundreds of hours practicing and applying it, which is completely tuned the way that I view the markets and anticipate price reversals. It's led me to, number one, be convinced beyond a shadow of a doubt that markets are not random and price does indeed repeat itself. And there's so many examples that I could point to that we won't get into today. Number two, it set me on a path to automating pattern recognition. And I'm sure you can imagine, the potential in automating something like that. So first, a quick history lesson, okay? History doesn't get pulled into these conversations very often, but I think it's important for this one because it helps to communicate the value and credibility of what I'll be revealing later in the topic of this technique that we're going to be talking about. So this pattern recognition technique in its most general form is referred to as market geometry. Market geometry is a term that broadly speaks to the relationship that exists between price and time. And using various chart drawing techniques, we can highlight this relationship to make market predictions. That's the basis of market geometry, okay? Roger Babson invented what he called the normal line, which is shown here in this old news article of one of his published charts. So you can see these lines here. These are his normal lines. And he became very popular after he made some pretty bold market predictions that ended up actually coming to fruition. In 1929, he predicted a significant market crash. And then literally a month later, the Black Tuesday crash happened, which signaled the beginning of the Great Depression. Okay, so Babson invented the normal line drawing technique and made some impressive and well-documented market predictions. In fact, he eventually was called on by US President Franklin Roosevelt to produce a market forecast for him. So it's very clear that he was an impressive analyst with an impressive technique. Some of you may not have heard of Roger Babson before, but I'm sure many of you have heard of median lines, or you at least heard of Andrew's pitchfork. It's actually one of the drawing tools that's built into NinjaTrader. So George Merkle developed the original concept of median lines, which are a derivation of Babson's normal lines. This is an old chart representing the median line in its crude form on a very old chart. You can see the basic structure that resembles a pitchfork that we now know. So George Merkle developed the original concept of the median line. Alan Andrews then introduced the concept of the pitchfork in the 1960s as an iteration of the concept of median lines, which was actually interestingly inspired by Isaac Newton's third law of motion. And then Edwards and McGee published a book in 1948 called Technical Analysis of Stock Trends, which is one of, if not the earliest publications on the topic of trend lines and trend channels. And I'm sure a lot of us are familiar with that, drawing a trend line, drawing a trend channel to kind of project price based on its current direction. So you're probably picking up on the theme here, right? All of these guys are using some form of drawing technique to assist in pattern recognition, specifically to identify price channels. They have the expectation that if the current channel that defines the current trend of price can be identified early enough, there's some predictive nature or forecasting opportunity there. So market geometry is a proven trading methodology that's been used for a very long time. The simple reason for that is that it's very powerful for anticipating price movement, which of course is exactly what every trader is after, right?